car maker says it's being hit by spiralling manufacturing costs and stiff competition from China, despite paying out billions of euros in dividends.
Automotive giant Volkswagen is facing the biggest layoffs in decades. Plans to close German factories may have fallen through, but drastic cuts are coming instead. Tens of thousands of jobs will disappear by 2030, and production will fall by hundreds of thousands of cars. What impact will this have on the economy, stocks, and the future of the European car industry? The German car maker Volkswagen will massively cut production and staff at its plants in Germany by 2030 as part of the overall downturn in the EU automotive sector. There will be several impacts. For example, the steel market is likely to feel the impact of lower consumption. The mood in the steel market in particular is pessimistic, especially in Germany, where many companies are reducing operations and announcing redundancies. This is not just Volkswagen. After several strikes and more than 70 hours of collective bargaining, Volkswagen and the IG Metall Union have finally reached an agreement that represents the future of the company until 2030. The carmaker's board initially pushed for the closure of 3 car plants, which was averted, but massive layoffs and significant production cuts were announced. By 2030, a reduction of 734,000 cars produced at all German plants is planned, and the workforce will be reduced by more than 35,000 people at all Volkswagen's German plants by 2030. Despite these overwhelming figures, IG Metall said it was satisfied with the results. The jointly stated goal announced for the Volkswagen brand, which is at the core of the Volkswagen AG group, is to become the world's leading manufacturer of high-volume vehicles in terms of technology by 2030. According to the carmaker, comprehensive capacity reductions at its German plants, and a significant and sustainable reduction in labor costs of 1.5 billion euros per year have now created the financial conditions for achieving this goal. Overall, Volkswagen aims to save more than 15 billion euros a year in the medium term. According to the latest figures, the automotive segment in the EU will have declined significantly by 2024. But what is definitely not declining is the number of subscribers to our channel. So join us and don't miss any more interesting videos from the world of stocks. New car sales in Europe fell 1.9% in November, driven by a 9.5% decline in overall EV sales, including a 21.8% drop in EV sales in Germany. Volkswagen's employee salaries will be frozen for several years as inflation rises and raises and bonuses will be cut, in some cases even from current levels, leading to a double-digit reduction in real earnings. If necessary, Volkswagen can reduce weekly working hours to 28 hours. On top of all this, we have tariffs from the US, which will hurt the car companies even more. However, the tariffs on car manufacturers are currently suspended for 30 days, so the real impact is not yet being felt by manufacturers. How do we get out of this whole spiral? The Volkswagen Action Committee is clear: not a penny in dividends. The right to work and a decent wage takes precedence over the profit interests of investors. Volkswagen, like other car makers, pays solid dividends. The last one the company paid out to investors was €9 per share. Since May last year, however, shareholders have received nothing. All of this has had a direct impact on the share price, which is now woefully low. Volkswagen shares can now be bought on the stock exchange for €111. In November, however, it was much cheaper, exactly 25% cheaper at €82. That's a 69% drop from the 2021 peak to today's prices. Find out if it's an interesting price to buy at 𝗕𝗂𝗶𝗀, where you can find in-depth analysis, a fair price based on DFC and relative valuation, or the opinions of other investors. Here you'll find everything you need to pick stocks like a pro, so check it out. But it's not just local car companies. Tesla's US sales in Europe are also having a rough time. Tesla's biggest European market has long been Germany, and year-over-year car sales there are down 71% for January and February. What's more, there was already a significant drop from 2023. France, Norway, Spain, Sweden, Denmark and Portugal all fell by almost half. The lone exception is Britain, where Tesla sales were up 8%. Overall, Tesla sales in Europe are down 44% from last year. Looking at Tesla's chart, you can see at a glance that these problems are showing up. Since the peak Tesla reached on December 16th at $489 per share, the price is now down 46.5%. This decline thus represents almost half of the company's value. We're talking about an $800 billion drop. Now, the price is around $260 per share. That's the same value as if you bought the stock in 2020. Are you investing in Volkswagen or Tesla, or have you given up on car companies? Share your thoughts in the comments. Good luck with your investments.